Hello everyone, my name is Dhruv Sani. Today in the course of financial management, we are going to discuss the concept of fundamentals of capital structure. You can see the meaning. The capital structure is a particular combination of debt and equity used by the company to finance its overall operations and growth. Debt comes in the form of bond issues or loans, while equity may come in the form of common stock, preferred stock, or retained earnings. As we can see, debt plus equity make up the capital structure. It is not the obligation, particularly not a hard and fast rule to raise this amount of debt and this amount of equity. It depends upon company to company. Basically, the preferred ratio is 2:1, two portion of debt and one portion of equity make a strong capital structure. And that is that we borrow from the outside party, and equity is like we have discussed earlier in the form of preference shares or equity shares. Components of capital structure we can say is there are two types of capital: fixed capital and working capital. Fixed is required for machineries which are fixed, and fixed assets, and like machineries, building, these require permanent fixture of your money. And working capital basically for day-to-day activities. So here's the difference. Fixed capital used for developing long-term capital assets used over a spread of time interval of more than 20 years. It is an one-time investment generally. The source for fixed capital is to be done with the long-term financing mechanisms. Working capital. It is used to negate the variable expenses for the day-to-day usage of the organization, as I said earlier, used to procure inventories and comes in form of T-bills. T-bills means treasury bills and short-term receivables. Types of capitalization. Here we can see there are three types of capitalization: overcapitalization, undercapitalization, and watered capitalization. Overcapitalization, the scenario in which the actual amount of profits won't suffice to pay the mandatory interest on debentures and obviously no dividends on equity shares, right? Undercapitalization, in this scenario, the amount of capital shown by the organization is pretty low. However, the organization has an undisclosed amount of reserves like retained earnings, other reserves. Watered capitalization is an unsecured form of securities usually used to raise capital without the organization's long-term capital assets backing them, right? So these are three types of capitalization.